Welcome, entrepreneurs. You are the backbone of this economy. You work hard, you innovate, you create jobs. But are you keeping as much of your hard-earned money as you legally can? Today is October 5th, 2025, and tax season is just around the corner. Many business owners will overpay the IRS, not because they made too much money, but because they chose the wrong business structure. This is a tragedy. It's like running a marathon with weights tied to your ankles. You can still finish the race, but it's going to be a lot harder and more painful than it needs to be. The good news is that you have the power to change this. The choice between a limited liability company, or LLC, and an S-Corporation, or S-Corp, is one of the most critical decisions you will ever make for your business. It's not just a box you check on a form. Think of it this way. Your business is a vehicle, and your business structure is the engine. A sole proprietorship is like a dependable sedan. It gets you from A to B. But an LLC or an S-Corp, that's like upgrading to a high-performance engine that's also incredibly fuel efficient. You get more power, more protection, and you save a ton of money on fuel, or in this case, taxes. This isn't some complicated loophole reserved for the mega-rich. This is a playbook written directly into the US tax code, specifically for small business owners like you. The government wants you to succeed, and it provides these tools to help you do just that. Understanding how to use them is the key to unlocking massive savings. We are going to break down these two powerful structures, the LLC and the S-Corp, in plain English. No confusing legal jargon, no boring accounting speak, just straight talk and actionable advice that you can use right now to put more money back in your pocket for 2025. So, grab a coffee and get ready to take some notes. We will explore what these entities are, how they are taxed, and why one might be vastly superior to the other for your specific situation. We will look at real-world examples with actual numbers so you can see the savings for yourself. Let's start with the basics. What exactly is a limited liability company, or LLC? Think of it as a legal shield. The primary purpose of an LLC is not tax savings, it's asset protection. When you operate as a sole proprietor, there is no legal separation between you and your business. If your business gets sued, your personal assets, your house, your car, your savings account, are all at risk. An LLC creates a separate legal entity. It builds a wall between your business liabilities and your personal life. This is a non-negotiable first step for any serious entrepreneur. It's foundational. Now, how is an LLC taxed? This is where people get confused. By default, an LLC is a disregarded entity for tax purposes. That means the IRS pretends it doesn't exist. If you are a single-owner LLC, you are taxed exactly like a sole proprietor. Profits flow to your Form 1040 on Schedule C. You then pay two types of tax on that entire profit: ordinary income tax and the dreaded self-employment tax. For 2025, self-employment tax is a flat 15.3% on the first $168,600 of your net income. This is the tax that kills small business owners. Who is an LLC good for? It's the perfect starting point for almost every new business, especially if you're bringing in $20,000 to $40,000 in profit. You get crucial protection without complexity. It's also great for holding assets like real estate. You can put each rental property in its own LLC to compartmentalize risk. If one has an issue, it doesn't take down your entire portfolio. The LLC is your utility player, your jack of all trades. Recap. It's a state-level legal structure, not a federal tax classification. Its main job is to protect your personal assets from business lawsuits and debts. By default, all of your net profit is subject to both income tax and the punishing 15.3% self-employment tax. It's an essential first step, a fantastic starting point. But as your profit grows, that self-employment tax starts to sting. That's when we consider a more advanced strategy, which brings us to the S-Corp. Now let's talk about the S Corporation, or S-Corp. This is where the magic happens for tax savings. First, a common misconception. An S-Corp is not a legal business entity like an LLC. You don't go to the state and say, I want to form an S-Corp. An S-Corp is a tax election, a choice you make with the IRS about how you'll be taxed. You can elect for your LLC or your C corporation. For most small businesses, form an LLC for legal protection, then elect to have it taxed as an S-Corp for tax savings. This gives you the best of both worlds. So how does an S-Corp save you money? It all comes down to avoiding that dreaded 15.3% self-employment tax. With a default LLC, 100% of your profits are subject to that tax. An S-Corp lets you split income into two categories: a reasonable salary and a shareholder distribution. The business pays you, the owner-employee, a reasonable salary. That salary is subject to payroll taxes. Payroll taxes are the same as self-employment taxes, just split between employee and employer. Any remaining profit can be taken as a distribution, which is not subject to self-employment tax. Who should consider this? S-Corp usually makes sense once your business nets around 40K, 50Ks or more, because there are additional costs and administrative burdens. You have to run payroll for yourself. That involves payroll service fees, and filing quarterly payroll tax returns. You also typically file a separate business return, Form 1120S. These extra costs might be around $1,500 to $2,500 a year. So you need enough profit for tax savings to outweigh those costs. The concept of a reasonable salary is critical. The IRS requires a salary reasonable for your industry and work. You can't pay yourself $10K on $200K of profit. That's a red flag for an audit. Do research on similar positions in your area. Even with a fair salary, tax savings on distributions can be substantial. This strategy is the #1 way most profitable small businesses slash their tax bill. So, you've formed your LLC, your business is growing, and you're ready to start saving on self-employment taxes. But how do you actually make the S-Corp election? The process is surprisingly simple. It involves filing just one form with the IRS, Form 2553, Election by a Small Business Corporation. This is basically the magic form that tells the IRS you want your LLC to be taxed under Subchapter S of the tax code. It's a relatively straightforward, 2-page form that asks for info about your company, its shareholders, and the effective date. Now, timing is everything when filing Form 2553. Generally, file within the first 2 months and 15 days of the beginning of the tax year you want the election to take effect. For calendar year businesses, file by March 15, 2025, to be valid for the entire 2025 tax year. New businesses have the same window from the formation date. Missed it? The IRS allows late elections with reasonable cause, but be timely if you can. After filing, the IRS processes your form and sends a confirmation letter, Form CP-261. Keep it with your important records. It's your proof. Once active, you must comply with S-Corp rules. You are now an employee, must run payroll and pay yourself a reasonable salary, and file Form 1120S each year. Payroll services like Gusto, ADP, or QuickBooks can handle calculations, deposits, and filings. The savings are worth it. Alright, let's put some real numbers to this so you can see just how powerful the S-Corp election can be. We'll compare Alex operating under 2 scenarios for the 2025 tax year. In both scenarios, Alex's business has a net profit of $100,000 before paying himself. Alex is single and takes the standard deduction. We'll focus solely on self-employment tax. Scenario 1. Alex operates as a single-member LLC, taxed as a sole proprietor. His entire $100,000 profit is subject to self-employment tax at 15.3%. That's $1,500 on top of regular income taxes. Money walking out the door. Scenario 2. Alex makes the S-Corp election. A reasonable salary is set at $60,000, which is subject to FICA at the same 15.3%. Payroll tax on salary is $9,080. Remaining $40,000 is taken as a distribution, not subject to SE or FICA taxes. Compare $1,300 versus $9,180. Savings $6,020. After about $2,000 in services, Alex still saves roughly $4,020. At $200K profit, savings scale dramatically. This is strategic tax planning, not a loophole. Choosing the right structure requires weighing advantages and disadvantages. No structure is perfect for everyone, it's about fit. LLC pros: simplicity, low setup and maintenance cost, fewer formal requirements, no mandatory meetings or minutes, low administrative burden, liability protection, great for many new or small businesses. Massive con: by default, profits get hit with 15.3% self-employment tax. As profits grow, this becomes inefficient. Every profit dollar gets extra tax. It can feel like a treadmill. S-Corp pros: tax savings, split income, salary and distributions, potentially saving thousands each year. Use savings to reinvest, save for retirement, and improve quality of life. It also adds credibility with banks, investors, and clients. Cons: more complexity and cost. You must run formal payroll and pay a reasonable salary, hold shareholder meetings, document minutes, and observe ownership limits. Generally max 100 shareholders and U.S. owners. Costs include payroll services and more complex tax returns. Make sure tax savings outweigh the extra burdens. The choice between a default LLC and an S-Corp election boils down to one key factor: your projected net profit. Let this be your guiding star. Honestly assess expected net profit after expenses. Don't guess. Look at past performance, your current client list, and your growth trajectory. A bit of forecasting now can save a fortune later. Rule of thumb: under $40,000 projected net profit, stick with default LLC. At that level, S-Corp savings are often eaten by admin costs. Enjoy simplicity. Focus on growth and service. Get liability protection without extra hassle. Crossing 40K, 50K, that's the break-even zone. At 60K, 80K, 100K plus, the S-Corp becomes a no-brainer. Savings rise with profits. Staying default becomes costly. It's math. Don't leave money on the table. Don't decide in a vacuum. Talk to a CPA. They'll review your numbers, set a reasonable salary, confirm if S-Corp fits, and help file Form 2553 correctly and on time. Think of them as your co-pilot. We've demystified LLC versus S-Corp, ran the numbers, and weighed pros and cons. Now, a clear plan. Aim for an LLC taxed as an S-Corp. LLC gives state law liability protection. S-Corp gives federal tax savings. Best structure for profitable small businesses. Step 1, form LLC. Step 2, grow profit above 50K. Step 3, elect S-Corp. If starting or under 40K, keep it simple. File articles of organization, get your EIN, open a business bank account, and build. Consistently at 50K plus, file Form 2553 by March 15, 2025. Engage payroll. Determine a reasonable salary. Operate under S-Corp rules. Don't overthink. Act. Evaluate your profit, call your advisor if you're over the threshold, and take control of your financial destiny. You've earned it.